So let's now do the final piece of this chapter. So this chapter is not that bad, just two big things. The first you've already covered, the flexible budget and the problem. My multiple choice questions will be within this range, and then we are doing this last piece of something called responsibility accounting. It's just a bigger word or whatever you have learned. More like responsible, who's responsible for what. So let's just talk about this, and we go from there. Okay, so responsibility accounting is that if you look at these three managers, each manager, this, for example, this manager is a department manager, and he's saying, I'm responsible for controlling costs in my department. And the lady is saying, who's a division manager, is saying, I'm responsible for controlling costs in my division. So, of course, department has its own role, division has its own role in a company, right? Has a much bigger role. And then let's say if somebody is a senior manager or president of a company, so the president is saying, I'm responsible for controlling company costs. So, there's kind of a hierarchy, that these managers represent, and they are responsible for controlling things, right? So these people are making decisions that make this company function. That's how these companies make money, profits, revenues, and costs. All those lines are controlled by these people, and the president is responsible for controlling the um, overall company in terms of its revenues and costs and how to allocate funds. So let's dig in more. So the key word here is control, controllable costs, controllable revenues, controllable, dollars, investment dollars. So these are those things that are controlled by these people. Okay, so we that's what we want them to be responsible for, right? Things that they can control by using their own personal logic and reasoning, and as working as managers when they make decisions that in terms of in their role as controlling their department or their division or their company. That's what we want them to be, and there's a special accounting for that. It's called responsibility accounting. So this is the last topic for it. So a decentralized organization, there's a spelling error, is kind of like this. It's a network. You have departments. These departments are reporting to a bigger department. The bigger department is somehow reporting to another department. There may be another circle that is relating these big circles. The point is there's a it's kind of this network of these departments and divisions, and that represent this one larger company that is somehow these are all connected, right? So and so now I'm going to show you, just as a sample, resumes of these CVs, right, of these managers that claim on their resume, hey, we are responsible people, right? That's what. So you're trying to project yourself as somebody who's done a responsible role, and so so for example, I'm reading here: supervise and motivate 17 engineers, provide cross-functional team training, coaching, mentoring, monitor, balance, and manage P&L, profit and loss, and budget. Right. So this is, and then key project successes. So this person is claiming here that they have delivered solutions, enabling a company to immediately initiate monthly charges of over 150,000, improved manufacturing productivity. That means higher output, less input, right? Lower costs, higher, and generate additional revenue. So here's another statement. Let's look at another resume by some Jesse Kendall, and looks like in this resume the person says delivered results because they're projecting, they were responsible, they were making decisions. It says saved $75,000 per year in fiber costs by designing and installing online weight monitoring system to control fabric weight. So the idea is that these people are saying, hey, we were making decisions here, decisions that were creating more value for this companies, right? So and whoever is reading that is making is saying, hey, this person can make better decisions, right, if they believe them. So here is another resume where they are saying examine standard costs against actuals to identify process inefficiencies, improvement opportunities, and low profit products, right? So again, this is, and this looks like a plant accountant, right? More responsibility means the person is making decisions, but here in this chapter we are trying to put that responsibility in an accounting report. Okay, that's why we are doing this chapter. So you can see that these are departments at the lowest level. They report to certain Chicago plant. Chicago and all the other plants report to a certain manager. Then these three managers, vice presidents, report to the president. So here, let's say you're looking at the responsibility accounting for a person at the lowest level. So there's a budget here, there's an actual here, and favorable unfavorable variance. So this says an unfavorable variance of $1,300 for this fabricating department manager. That report, that bottom line becomes a one line under here under fabricating, right? So this was the whole complete fabricating controllable costs report, which is under responsibility accounting, that this manager was responsible in fabricating department, right? Now we are creating a responsibility accounting report for the plant manager in Chicago, which has three other plants, and they are generating separate variances, right? Budget versus actual, and that 1300 is showing as one line item here because the responsibility of the Chicago plant manager, is not only for fabricating but also for other departments, right? So you have all this, and it's some total variance is 5300 unfavorable. Now, that 5300 unfavorable becomes a small piece of the senior manager, who's not only responsible for Chicago but also for Detroit and St. Louis. And then the same thing for this unfavorable variance for 7300 becomes just a small piece for the president, whose president is responsible for the whole company. Production is one thing. The president is also responsible for sales and finance. And so for the total company, the 11,800 unfavorable variance, right? So if you're from a president, when you're in a meeting, right, and the president says, why my production is unfavorable, wants to understand, then the president can control the lower vice presidents, right? So we'll talk to the vice president and say, what was going on, tell me, which created 7300 unfavorable variance for production. So then that report will come. President and the vice president production can have a meeting together. Then from 5300 you can go drill down here and you will get more and more information, right? So responsibility accounting leads to this information about who's controlling what, who's responsible, and in that sense. So let's go further. So this is a great thing. Responsibility accounting is a big tool when it comes to decentralized companies. A lot of companies have decentralized sort of way to manage companies. Centralized companies also exist today, but I guess most of these large companies are decentralized. Um, responsibility accounting is a great tool to run such organizations. Okay, so here again, I am emphasizing the word between controllable and non-controllable costs. Controllable costs are those costs that are controlled, that are under the umbrella of the decisions of the manager, who can decide what to do in that department. But if the manager cannot make any decision related to some costs, that's non-controllable costs, right? I remember working in a bank. We used to get allocated in the so I was in the retail and small business lending area of the bank, um, in their finance division. So I remember there was some marketing costs that were coming from the bank-wide decisions, and the retail and small business manager, or I remember that position was vice president of retail and small business lending, had no control over the advertising cost that was done at the bank level. Okay, because retail and small business was one division of the big bank. So if if a manager cannot control those costs, that will not be considered in the responsibility accounting report. That's the idea. We don't want to put those costs in the report of a responsibility based on responsibility accounting, where a manager cannot control those type of things. So this is a big distinction. We will look at that. So, for example, the person at the back who's running the show is responsible, right? The responsibility or controllable things are the hand and maybe the legs of these two gentlemen here. But if this person talks, the um, the guy who's running the show is not responsible for that. All he can do is move the foot and the arm motion, right? So that's the only controllable thing that is available to the person at the back here who's controlling the show. So the other movements may not be controlled. Okay, so eye movement is not under that control. That's what we are trying to say here. Okay, so if you're a pilot, um, you can control the direction of the plane, you can control the engine speed, the height, and all that, but you cannot control the weather conditions, right? If there's a storm outside, and because of that you can get your plane is not operating properly, that's not under your control. So the pilot um, will be responsible for what he or she can control. So that's, and usually if the plane crashes and there's an investigation afterwards, and they find that the weather conditions were so bad that the plane was not controlled by the pilot. No pilot could control it because of the weather conditions, storm conditions, the wind conditions outside the plane. Then the pilot is let go, like free to fly again, because it was not under the control of the pilot. So that's where we are trying to go, right, with these responsibilities reports. So there are three kind of responsibility centers where we prepare these kind of reports. One is called the cost center, profit center, and investment center. This is very I'm going to go through them, covering the main points, and that's where your multiple choice questions will be. And I have these 1-2 questions that I will do right after this, just to show you what type of quantitative type questions that can be asked. And this chapter is pretty nice and decent concept. So, cost center is the first responsibility center. Some managers are just responsible to manage the costs. They incur costs. For example, IT department in the university, okay, Penn State IT department, all the manager does in an IT department is basically make sure that the costs related to the department, the salaries, the equipment, any software, all those costs are incurred in under control of the IT department manager, and so the manager is only responsible for those decisions. Okay, manager is evaluated on the ability to control such costs, and usually a production department, like in a factory, if you're producing iPhones, you are responsible to manage the cost of the iPhones, right? Or a service department like IT. That's the first kind of cost center where we prepare responsibility accounting report, and I'll show you in a minute. The next one is the profit center. In profit centers, the manager is responsible not only for incurring these costs but also generating revenues. So a manager is judged on the ability, on the profitability of the center, right? So you not only are managing these costs but the revenues, and revenues minus costs is profit. So a bank branch manager or a Home Depot, one of their location, right, is a profit center because it's generating revenues and costs. And then finally, we have investment center. Here, a manager is not only responsible for managing costs but also revenues, and also has the responsibility for managing funds. So you manager is able to make decisions to increase return basically on investment. So uh, so so you're given funds like that. Okay, you have $1 million. You generate return on it. So return on investment is that's the kind of an idea where the manager is not only responsible to control the revenues and costs but also return on investment, because that investment dollar is what has been allocated for the manager in this case. So we'll dig in more into that. So for the cost center, all you have to do for the responsibility center is manage expenses. In the profit center, it's expenses and revenues. In the investment center, it's not only revenues and expenses but also return on investment. Okay, so let's do this. First, under responsibility accounting, the evaluation of a manager's performance is based on matters that the manager directly or indirectly controls, has shared responsibility. So A is the answer. The reason is because if a manager cannot make decisions, cannot control things, we should not make them responsible, because making somebody responsible for something that they cannot control is kind of unfair, right? So we only care what they can control. Okay, so let's now look at the responsibility accounting for cost center. It's the again controllable, and what we care in this report is what are the controllable costs, or what are the variable or fixed. We don't care about them as long as they can be controlled by the manager for that department. We are we're going to consider that. Okay, so there's no distinction between variable and fixed. It's the only thing that matters is controllable costs. What are they responsible for? Can they make decisions? Are they able to make decisions to manage those costs? If they are, and that's what they're responsible for, you better include them under responsibility accounting, right? And it's the idea is that you put the budget here, you put the sorry about that, put the budget column, you put the actual column, list all your controllable costs, and find out the difference. That will determine the performance evaluation. Okay, responsibility accounting for profit center. Here in this case, you have a control on operating revenues earned, like sales, for example, and all the variable costs incurred by the center that varies with sales. Okay, so it's the relationship is again controllable, is based on the idea of controllable, and it's about sales and all those costs, variable costs that are incurred by the center because they vary with sales. Okay, so that's one thing. The fixed costs, again, those costs which are traceable to that center. Okay, so this idea is a new word that things, all those fixed costs that are related directly to the center, to that profit center, and all those costs that are incurred for the benefit of that center, those are called traceable costs, and the manager is responsible for those type of costs in terms of including them in the responsibility accounting report. Most direct fixed costs are controllable. Okay, so that's the idea for fixed costs that are direct and controllable, and that benefit the profit center. But there are some fixed costs that are indirect, and they are there. They are part of that division just because you are a part of this bigger company, right, as a division. So I gave you the example earlier where advertising cost of the big bank was allocated to this one division of that bank, which where I worked, which was retail and small business lending. And whenever we used to see that advertising costs allocated by the department, there's always debate, whether we should have such a big charge or not. But when it comes to the responsibility accounting, those type of costs are not controllable by the profit center manager and should not be included in the in that report. So these are called common costs. Okay, so common costs are not controlled, and they should not be included if they are not specifically and not under the control of the profit center manager. So this is how the profit center report, responsibility report will look like. You put all the budgets here, you put all the actual here, you put down your sales number, you put down your variable costs and your contribution margin, you put down all controllable fixed costs, all the common costs, all for example, here it says the marine division also had 60,000 of indirect fixed costs that were not controlled by the profit manager. They should not be part of the responsibility accounting report for such division. Okay, so I'm going to show you that in the example that's after this, so just bear with that and you will see how that works. Responsibility accounting for investment center, again here we will use a different sort of a tool, and the idea again is same, that you should only include those costs which are controllable. So put the controllable margin on as a numerator, divide by the average operating costs, and your return on investment is what you get when you divide controllable margin by average operating costs, you're talking about return on investment. This is the this is what we use to evaluate managers that have control over not only expenses and revenues but also on the investment dollars. Okay, so we'll see that how this works in the example after this. Thank you.